Good morning/afternoon, ladies and gentlemen. On behalf of HAC Auditing Company, I am pleased to present our initial overview and analysis of the ADP Joint Stock Company. Crucially, we will be focusing on ADP's significant strategic shift, their negotiation to acquire ABB Paint Company to enter the mid-range segment, financed by a planned $3 million USD loan from UOB. Let's begin the detailed analysis, moving on to the core of our analytical work, addressing the first 2 points on our checklist: performing trend analysis, calculating financial ratios, and understanding the meaning of these procedures for us as auditors. Let's quickly summarize the key trends and structure of ADP's balance sheet for 2023. Overall growth: the company's total assets saw a solid increase of 6.37% in 2023, reaching over 381 billion VND, signaling continued growth. Asset structure: the company maintains a highly liquid structure with current assets dominating the balance sheet, increasing by nearly 10%. Current asset shifts: however, within current assets, there are dramatic shifts. Cash and equivalents soared 72.30%, while accounts receivable dropped significantly by 20.66%, and inventory jumped 67.07%. This shift from receivable to cash and inventory is highly unusual. Financing structure: the company maintains a very strong solvency position with owner's equity growing by 4.69%, still financing the vast majority of assets. In short, the company is growing, highly liquid, and strongly financed by equity, but the unusual movements in cash, inventory, receivables, and customer advances require immediate attention. Next, let's quickly analyze ADP's income statement. This reveals a dramatic story of shifting costs and exploding profitability, revenue and cost dynamics. Net revenue decreased by 12.12% due to intense market competition. However, cost of goods sold dropped even further by 16.37%. This relative movement is highly favorable. Profitability surged. This efficiency resulted in gross profit increasing by 11.65%, pushing the gross margin up significantly from 15.18% to 19.28%. This remarkable surge confirms strong control over production costs or effective price management. Expense control: we also note positive trends in key operating expenses. Selling expenses decreased by 32.70%, and general and administrative expenses fell by 14.41%. This demonstrates excellent expense discipline and contributes significantly to the bottom line. Audit focus: while profitability looks excellent, our audit focus must be on verifying the drivers of the gross margin expansion and substantiating the abnormal spike in financial income and the sustainability of the large cuts in selling expenses. In summary, ADP has managed to dramatically improve profitability despite a drop in sales, but we must audit the sources of these gains to ensure they are sustainable and correctly reported. In summarizing the ratio analysis, the company presents a financial profile with strong profitability but key operational challenges. We maintain strong overall liquidity, current ratio at 3.6, supported by a strong 54% increase in cash reserves, although immediate liquidity, quick ratio, dropped 12%, is lower. Operationally, the company is struggling with slower customer payments, receivable turnover dropped 16%, and a major slowdown in inventory turnover, which down 39%, which carries a high risk of overstocking and points to lower efficiency in using working capital, down 17%. However, these efficiency issues are currently overshadowed by superb performance and profitability. We achieved better cost control/pricing, leading to a strong 67% improvement in net profitability and resulting in significantly higher returns on assets and equity. Asset utilization was reduced.
Finally, the company remains financially secure with no long-term debt, maintaining a very low financial risk, even though total liabilities to equity and assets are slightly up.
So what does this procedure mean for an auditor? 1. Enhancing the auditor's understanding of the entity's financial position and operations. By analyzing ratios such as leverage, liquidity measures, inventory turnover, and profitability ratios. For example, ROS, ROA, ROE. Auditors obtain an overall perspective on the entity's financial health and operational efficiency. This supports the requirement under ISA 315 to gain an understanding of the entity and its environment. 2. Assisting in the identification of risks of material misstatement. Unexpected fluctuations or unusual relationships in financial ratios may indicate potential fraud risks, for example, overstated revenue to manipulate profitability ratios, misstatements in asset or liability balances, or issues related to liquidity that may affect appropriate financial statement presentation. 3. Supporting more efficient audit planning. Financial ratio analysis enables auditors to focus audit efforts on areas with higher risk. For example, a disproportionately high inventory to working capital ratio may necessitate increased attention to inventory valuation and physical count procedures. A high debt ratio may require further examination of borrowings, debt covenants, and contingent obligations. 4. Providing corroborative audit evidence. Under ISA 520, analytical procedures may serve as substantive evidence, particularly when the entity's information systems are reliable and account balances are stable. Or overall review procedures at the completion stage of the audit to assess whether the financial statements are consistent with the auditor's understanding of the entity. 5. Assisting in assessing the reasonableness of financial information. Where financial ratios deviate from prior periods, industry benchmarks, or expected trends, auditors are required to trace to supporting schedules, seek management explanations, perform additional substantive tests where appropriate. Finally, about the abnormal items that we should investigate. Firstly, abnormal from SOFP. Cash increased by 72% while short-term investments decreased. The company may have liquidated short-term investments to increase cash. While inventories increase sharply, receivables decrease, indicating a major change in sales and collection policies. Fixed assets decreased 15.47% and construction in progress decreased sharply 49.93%. A sharp drop in CIP could indicate that projects were completed and transferred to fixed assets. High trade payables, 22.54%. Combined with a sharp increase in inventories, this could be a sign of massive purchases of raw materials that are not being produced or sold. Customer advances spiked 323%. A sudden increase in advances may signal that the company is recording revenue prematurely or manipulating the timing of revenue recognition to meet targets. Payables to employees decreased sharply 34.60%. This decrease could be due to personnel changes, labor cuts, or changes in salary and bonus policies. Secondly, abnormal from SOPL. Revenue decreased greater than 12%, but profit increased greater than 46%, indicating understated expenses, overstated other income, misclassification of expenses as capital expenditures. COGS decreased 16%, while inventory increased 67%. Overstatement of inventory, improper costing methods, FIFO, LIFO, weighted average misapplied. Profit after tax increased by $18,888 billion, but retained earnings decreased by $7,122 billion. All of 2023's profit after tax, $58,934 billion, and part of the previous year disappeared. The difference of approximately $66,056 billion is extremely large. Finance costs increased by 114%, The company may have taken on new loans or increased credit lines, resulting in higher interest expenses. Selling expenses decreased by 33%. The company might have cut marketing, advertising, or distribution costs. Other income decreased by 98%. Failure to record or recognize other income, gains on investments, asset sales, foreign exchange gains, or miscellaneous income. Thirdly, abnormal form ratio. Cash ratio increased by 54%. Large increase in cash relative to current liabilities is unusual. Inventory turnover decreased by 39%. Sharp decline may indicate overstocking, slow-moving, or obsolete inventory or misstatement. Net profit margin increased by 67%, very high increase, despite slower revenue collection, potential earnings management. Receivables turnover decreased by 16%. Slower collection of receivables could indicate aging or uncollectible accounts. Return on equity increased by 45%, very high increase. Auditors should check for unusual income items or equity changes.